company, like we ensure that the corporate governance is utmost priority is being given. So this all gives the confidence for the shareholders, saying that their right has been protected. So these are the various initiatives has been undertaken. Then coming to again only for the question of this education, we also, SEBI as a whole, we also invite various colleges to come to our office, and we make a presentation about the developments in the capital markets and as well as the general financial products. So these are like we wanted to start this culture from the young age itself, not at the age of 50, 60. So at the young age, like if they've been developed, it can be easily, they can be molded and they can be very well aware of their financial needs and the plannings. And then like we also have an institute only for the dedicated for this, is called as NISM, that is National Institute of Securities Markets, which is in Mumbai. So they conduct various courses, and they have a various certification courses also. These certification courses also we insist for some of the market intermediaries to obtain that, because that gives, when they go for the investor, they are very well educated and they can explain about the products. We also have a certification course, or we also have the registered intermediary called as investment advisors and the mutual fund distributors. So all these people, they have to pass certain kind of the qualifications. So when they approach you, they are very well educated and they were very well updated. So these are the initiative is being taken by SEBI regarding the investor educations. And we also conducted a competition program for the school students, that's school students from class 10th to 12th, sorry, class 8th to 10th. So wherein like we conducted some programs regarding these financial products, and we also given some awards for them. And we are also in touch with the NCERT to say that like the regular syllabus can be incorporated from the school level itself. So these are the initiatives being taken by SEBI for educating the investors. And being this is an important initiative by ET, I think like this should go a long way. And after coming to the primary market and the secondary market, if anyone has got any grievance about the listed companies, we also have the computerized tracking system called as scores. So a person can log into the scores and he can file a complaint, need not go through the physical complaint, where in the olden days we used to have this share certificate in the physical format. Now we are trading through the DMAT. Like that, like we also wanted to introduce this computerized way of tracking it. The system is also helping the investors from the nook and corner. They can file and they can track their systems. So this is called as the score system. And we also have the facility called as the toll-free system. So any person who has got any complaint, they can call up our toll-free center and they can ask for their doubts to get it clarified about their complaints and something about the secondary market and the primary market or the capital markets. Then having said all these things, like SEBI, after passing so many orders, we also telecast even in the TVs and sometimes in the newspapers, cautioning the investors. So the intention is that like be aware of your money and it's be safe with your money and deal with only the registered intermediaries. We also have something called as do's and don'ts. So we generally circulate to the people. It says there's do's and don'ts. It's the deal with only the registered intermediaries. Generally, like in case of any complaint, the SEBI can come into the picture and take action against them. So then do not borrow money and invest. Some people, they have the concept of like we'll borrow some 10,000 and we'll invest, so my money will double. So generally, like avoid borrowing money and investing. You only invest only through your own money, own hard-earned money, and manage that money in a smarter way. That's better instead of borrowing the money. Then after all these steps have been taken, we also have a class of the concept called as foreign portfolio investors. So you know that like because of our robust risk management system and the development in the secondary market, and it's a T+2 rolling settlement and with the DMAT trading, so that foreign portfolio investors, they have a lot of interest in our market. So we have more than 2,000 plus foreign portfolio registered investors. And because like as in the opening remark, they were saying that the market is merged, it's a global market. So a lot of people, they invest money in our Indian market because of the strengths and because of the systems we put in place. So with all these things, like I would stop at this stage, saying that like be careful about your money, please invest your money only with the registered intermediaries and with the companies having the good track record. And do not invest your hard-earned money with the collective investment kind of schemes or the Ponzi schemes or the MLM schemes, and don't lose your hard-earned money. So with this request, I think I'll stop currently. Thank you.
Thank you so much for your insightful words, sir. But we would request your presence on stage for a couple of more minutes. I would request our honorable chief guest to unveil a special book by Birla Mutual Fund titled My Life Goal Planning in the area of financial literacy. I would like to call upon stage Mr. K.S. Rao to present the book to Mr. D. Ravikumar, please. Can you have a round of applause, please? Ladies and gentlemen, let's have the round of applause going, please.
Ask for advice.
To come on the stage to collect the first copies. I also invite Sandhya to be here. Thanks a lot, sir.
We'll request your presence for one more moment, please. I would now request Ms. Sandhya Dhar to present our honorable chief guest with a token of appreciation. Ladies and gentlemen, the book, My Life Goal Planning, is available downstairs, so kindly collect your copy on your way out. We'll quickly break for a tea and coffee break. We're going to give you about 15 minutes because we have a whole set of sessions, insightful sessions coming your way. So before we start off with all that knowledge coming your way, grab yourselves a nice cup of coffee and tea and come back really soon. Thank you so much. Welcome back, ladies and gentlemen. So I hope you got yourself some nice refreshment because we have a lot of information coming your way. So get ready to absorb a lot of knowledge that's only going to make you wealthier. And wealthy makes you healthy, right? So, great. Moving on, our next speaker for the evening is Mr. Sabyasachi Mukherjee, Head of Personal Investment Consulting, IIFL. Mr. Mukherjee is currently associated with India Infoline as the Head of Personal Investment Consulting and is in charge of the advisory team. He has previously worked as Senior Manager, Products with ICICI Securities and has also been an Assistant Professor. Mr. Mukherjee has extensively trained participants from organizations like SEBI, NISM, and IRS officers in derivatives of financial planning and wealth management. He has appeared in investor camps conducted by business news channels as a speaker and has written for different journals and newspapers. Thank you, sir. The rise is all yours, please.
Good evening, everyone, and welcome all to the investor conference. See, it's rightly said, good things come in small packages. So 15 years of experience in 15 minutes. But I can assure that will lead you to a healthy and wealthy life as mentioned. And it will definitely make you decide upon a part of your finances and you will be able to maintain it on your own. Right? So talking of the investor conference, I take the cue from the word investments. I'll take a very small example. And a statement that I made, it's a bold statement. Is it really risky to not invest in risky assets? The statement has got a depth in it. I take an example. Mr. Rao invested rupees 30 lakhs in a flat in Mumbai during 1983. Right? During 1983, invested 30 lakhs. We think that properties, real estate always give a exceptional return. But during the same time, he missed out on investments, on investing in the Sensex, the stock market, or the gold as an asset class. The result in 2013, I didn't take the bull run. I didn't take the exceptional bull run of 2014 that I started. I just stopped it at 2013. His sell value of the property was approximately 21 CR. Good, huge one, 21 crores. But the Sensex return or the Sensex value was around 27 crore. Investment in real estate, when he has done, he has to pay taxes also. So once I reduce that from it, he has paid 4 crores tax. So 17 crores is his return. So on an average, he has earned 16.13% from the market, and from the real estate, it's around 14%. And I didn't even consider the gold at this point, which is giving a yield of around 9.32%. So is it really risky to invest in a risky asset? That's a marked question. People who have got time should go ahead and start investing in risky assets, and that should form a part of portfolio. How do you invest? Do you put blindly in equity? I'm not saying you put all your money in equity or in a risky asset. No. You can even do something which is most practical and which actually creates wealth, is known as asset allocation. That is, you transfer your money in kinds of asset, various asset classes. The various asset classes that I have considered is gold or commodities, equities, and the fixed income, which can be fixed deposit, which can be bonds, G-Secs, anything you consider, which has an average return of around 8 to 10%. So I've taken a data points for 20 years, starting from 1995 till 2014, around 20 years. And if you see, and during one point of time, equity has given, say, 1995 minus 23% return, but other it has got offset in other asset classes. So if I take the combined return in the 20 years time, only in 2 years it has given somewhat of a negative return. Otherwise, the entire portfolio has given a positive return. So if you have to create wealth, please ensure that you do a proper asset allocation. And if you consider 2008, people will say the market crashed, the investors like us were in a state of shock. But you maintain that asset allocation. What does maintenance of asset allocation means? See, you start with the asset allocation 50% in equity, 30% in gold or fixed income, and 20% in gold. If equity doubles, your portfolio value from 1 lakh goes to 2 lakhs. You again maintain that asset allocation. That is, you sell off the equities and come back and proportion it with the fixed income and the gold. That is known as maintenance of asset allocation. And if you do it on a constant basis, you will see that wealth is getting created, maintained, and generated. So asset allocation is the most important thing. So in this 15 minutes, the first thing that, and the last thing that I should mention, the most important thing that I should mention is the asset allocation. The right mix. Direct investments can be done. It can be done through equity, direct equity. It can be done through bond. It can be done by buying gold. I prefer more than physical gold, the gold ETFs. Or it can be done through mutual fund. Mutual fund, the fund managers take the responsibility, the owners, of maintaining that asset allocation. There are a lot of funds that do a dynamic asset allocation for the investors. So pick out funds according or as per your goals and as per your asset allocation. So visit the fund houses, check out the details, and invest as per. I've just given an asset mix. If you are a moderately low, it's on the left side, it is the low risk profiles, and on the right side, it is the high risk. So if you want a moderately low profile, you want a risk taking ability, for 3 years, you can park your money in short to medium term bond funds. If you are thinking of a 10 years, 15 years thing, just go to sectoral funds, thematic funds, REITs, take into risky asset classes. So mutual fund is one avenue where if you yourself don't have a time, you can rely on the fund managers. When do I start investing? This question comes to me every minute. Is this the right time? There is only one example I give to the person concerned. It is the right time, start investing. if you see the asset allocation rule, people say if you are in the age of 50 or if you are in the age of 30, it should be 100 minus your age should be there in the equity. So if you are 30 years, 100 minus 30, that is 70% should be in equity and 30% should be in, 100 minus 30, that is 70% should be in equity and 30% should be in the fixed income. If you are 50, 50% in equity, 50% in the bonds. If you are 90, still 10% should be there in the equity. But do we maintain that? No. Everyone says if you are 70, don't invest in equity. But trust me, there are investors who are still 75, still maintain a big, huge portfolio of equity. So start investing in equity as an asset class. Is it the right time? The question starts here. I have taken an example at the age of 35 and 40. I didn't go to 25 or starting at 20 because that's a perfect age to start. But still I said you make your money, you stabilize, then you think of investing. So 35 and 40. A person is investing only rupees 5,000 per month till the age of 60. It is really, really surprising to know the difference in investment is only rupees 3 lakhs while the corpus that gets generated is approximately 87 lakhs more. So by investing 5,000 rupees and a difference of only 5 years, you get a corpus difference of 87 lakhs more. And I have taken a very conservative rate of interest of or compounding rate as 15% only. So the first thing is, yes, this is the right time to invest, start investing. Where do you invest? Speak to an expert, speak to an advisor, read the blogs, go and invest. But do invest through the asset allocation process. Is it late to start? Or we can start now? We can start now. But the quantum of investment will increase. So if a person starts at the age of 25, by paying only rupees 13,500, he can reach 1 crore at the age of 60. While the same person starting at the age, at a much later age, will have to pay a higher amount or a higher corpus to get the same 1 crore. So start early, start small. I speak a lot about equity. Equity is a favorite asset class for me. It gives a exceptional return, but the risk are more. The best statement that I do convey is, more money has been lost by investors preparing for the corrections or trying to anticipate correction than has been lost in the correction itself. People wait. Market will come down, I will invest. Market comes down, he waits. Market will come down, I will invest. He waits. Market goes up, he said, I missed the bus, I will invest. He invests, again it comes down, he is in a panic situation. I made a mistake. It went up, still I invested. Now I will wait. It again goes up. He said, no, I will now get out of the market. That's not the way to do in equity. You should buy fundamentally strong companies, have faith in those companies, read research reports, and then invest. Then if you buy a good PSU bank, you won't be shocked if it comes down because you know it's a fundamentally strong company and you have faith in that company. So never wait for a market correction to come, but go ahead and start investing. This slide was prepared around, say, a couple of months back, where people were saying that what will happen to the under ownership of equities. We were in a conference where we stated, yes, under ownership of equities is going to change. And that is getting reflected more and more in the mutual fund data. If I take the data point of 2014, approximately 23,000 crores has come in the AUM for the mutual funds house. But you will be surprised to know more than 54,000 crores have come as AUM for the mutual fund house till September 2015. So 9 months have doubled the 2014 corpus. So people are coming in hordes. Is our market stable? Our market is stable. It's a world-class market, monitored perfectly by the regulators. The reflection is the sentiment, where in 2008, we were more dependent on the FIIs. The FIIs sold approximately 15,000 CR. The market came down by 25%. In September, they sold around 14,000 CR. The market reflection was around 9% correction. So we can say the market has matured. People have started having faith on the regulators, on the system, on the equity as an asset class, right? This is a good graph. People say, I want to buy gold. South, everyone I see, someone is weighing something of gold, right? But trust me, I'm not weighing any gold. yes, I invest in gold, a small percentage of 5 to 7% in ETF, but not physical gold. Gold has performed, if you see, every asset class has got its cycle. Like every business has got a cycle, there is an upturn, there is a downturn. Every asset class has got an upturn and downturn. Gold till now was on the top. But if we see 3 years down the line, you will see that this scenario has changed. 3 years down the line, if I come here, you will see equity has started moving up and gold as an asset class may have come down. The reason is any asset class moves when money chases it. That's more important. So you have to identify where is the money coming from and where is it going. Is it following the equity? Is it following debt? Or is it following the commodities? So you have to understand that and invest accordingly. So it is never something like you buy and forget. It is rather spend every Sunday at least 20 minutes to 30 minutes understanding your investment. Don't lay it like that. No, I have invested, I forget. No. Read it, read about the investment, track the investment, and if anything is required, take the help of an advisor and change it. These are some of the terms I have picked up this time, like PE, price to book value, market capitalization. What are these terms? How can they determine when to change the asset allocation? Because when I was discussing the asset allocation, I discussed that you have to change your asset allocation also. When do you think that equity is warming up and it's right time to move away? These are not direct examples which you should follow or currently. That's why I have blocked the data till November 2014, where the first data I have taken is the PE, price earning ratio. It's a very commonly heard term. You open any of the business news channel, you will see the PE word is mentioned at least 10 times in 10 minutes, right? So the price earning ratio is a good indication that how the market is being priced. That is for earning how much the investor is ready to pay, right? So generally, if you see the Nifty is in a range of, say, bottom it has touched around 10.4 and in the top it has touched around 28.6. This was during the boom period. But on an average, it is in the range of 18 to 20. So there are bands where we say, if it is reaching in the band of say 22 to 24, be cautious, the market may be hit.